The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University. This is EconVersations, a joint production of Troy Trojan Vision and the Manuel Johnson Center for Political Economy. Now, here's your host, Dr. Dan Sutter.
Hello and welcome to EconVersations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. Cryptocurrency exchange FTX and its founder, Sam Bankman-Fried, came roaring out of nowhere in 2018 with celebrity endorsements from the likes of Tom Brady and Larry David and the naming rights to an NBA arena. And then just as abruptly, FTX collapsed into bankruptcy in November 2022. Is this what we should expect from a cryptocurrency firm, since after all, cryptocurrencies are ultimately nothing more than computer code? As a tale of greed, the narrative seems a little misplaced because Mr. Bankman-Fried was a vocal proponent of effective altruism, who claimed he was making money just to give it away. What lessons does the collapse of FTX hold? And just what exactly is a cryptocurrency exchange after all? Joining me on EconVersations today is a regular guest, Mr. Peter Earle, an economist with the American Institute for Economic Research. Mr. Earle studied engineering at the U.S. Military Academy and then earned graduate degrees in economics and finance and worked in finance for 20 years before joining AIER. So I often turn to Pete for insight on events in the world of finance and commodities. Welcome back to the show, Pete.
Great to be again.
Well, let's just start with a little bit of history here so that people know exactly who might have just heard glancingly or offhand about FTX. Tell us a little bit about the company and its, I guess, first very famous founder and now a sort of infamous founder, the Sam Bankman-Fried.
Sure. So all of this starts with a hedge fund called Alameda Research, which was formed in 2017 by a number of traders and analysts who left an obscure hedge fund called Jane Street. Alameda's involvement in crypto started with a focus on arbitrage. In this case, Sam Bankman-Fried and a few of his associates were focusing on arbitrage in Bitcoin, which means looking at the very same Bitcoin in different markets with different prices. If you can trade them at different prices, and as long as your clearing costs and your foreign exchange conversions aren't too high, you can make money. So they got very good at that, and then over time they purchased the assets of a handful of other crypto firms, and at one point they decided to start an exchange. FTX followed in May or June of 2019, and then with a series of acquisitions and some venture capital investments, grew to roughly valued at about $32 billion in January of 2022.
And so let's talk a little bit here about cryptocurrency. So let's remind our viewers, because they might have heard of Bitcoin. We've had some shows on Bitcoin before, but let's be clear. What exactly is a cryptocurrency, and then what would exactly a cryptocurrency exchange be involved with?
Sure. So a cryptocurrency is essentially a digital currency, but what makes it different than many others is that the transactions are recorded in a decentralized encrypted format called a public blockchain. What that means is that there are many, many remote firms that are basically running the transactions. They're called miners, and it's very hard to shut down because there's many different decentralized servers, whether they're owned by people or by universities. They're taking part in recording those transactions.
And then Bitcoin can serve as sort of a medium of exchange, a way for people to make payments to each other, whether next door or across the globe, right?
Yeah, Bitcoin functions essentially as a medium of exchange, which is, of course, one of the functions of money. The other, store value and unit of account, it doesn't, especially store value, it doesn't do very well. Unit of account would take a very long time to do. But there are thousands, probably tens of thousands of other cryptocurrencies, some of which are cryptocurrencies by that strict definition, some of which are mere tokens. And the crypto environment, the crypto ecology, is vastly more complicated than it was even 10 or 11 years ago.
And so then, you mentioned their cryptocurrency exchange. I mean, I guess I remember visiting once the Chicago Commodities Exchange. So what's involved with a cryptocurrency exchange?
Yeah, so FTX was a financial exchange similar to a stock exchange. There are many others as well, although it's obviously virtual. There's no physical trading floor. But in other words, the function is basically the same as you'd find with a stock exchange or a commodities exchange, options exchange. It's a location where individuals can buy and sell cryptocurrencies and other instruments. But what's different about exchanges in the crypto world is that most of them double as brokerages as well. So in the regular world, you would have your money at a brokerage, and you would say, I want to buy 100 shares of Coca-Cola, and that brokerage would be a member of the stock exchange. They would do that transaction, cash would go out, stock would come in and go to your account. Mm-hmm. But in many cases, these crypto exchanges are also the brokerage firm. So your money and your positions are stored right at the exchange.
Okay. Now, you mentioned that Sam Bankman-Fried and his colleagues started sort of like arbitraging these different prices of Bitcoin. And that's an important function in economic markets as well, because they're starting
Absolutely.
to bring those prices together so that you have like one consistent price across different markets for this same commodity or same currency.
Right. Yeah. No, I mean, it increases market efficiency, lowers costs, and it also, it makes like so much of economics, it makes an inconvenient or a negative point a profitable one, which is those differences, those slippage elements that occur between markets become profitable. So there's an incentive for traders to go out there and try and hammer them out, which means the cost of a Bitcoin, in this case, could be a stock, could be anything else, could be a commodity. The cost of a Bitcoin in the US versus in Korea is at a minimum versus where it would be without arbitragers trying to make money off of those differences.
So far, although, I mean, sort of high tech or new in some different ways, it's also a relatively familiar function here for in the world of economics and finance. And it's sort of how we're seeing a market come into existence and become more efficient and ultimately help people make transactions better. But then things went, like you said, in the beginning of 2022, FTX was estimated to be worth over $32 billion. And then it all came crashing down, and it seems like there was, some old-fashioned misdeeds going on here, weren't there?
Yeah, absolutely. There's a number of them we can get into, and some of it has to do with really one of the sources has to do with the FTT token. Mm-hmm. Which was essentially, there's not a lot of equivalents of tokens in the crypto world, in the regular securities world, although they sort of emulate. My light just went off. Sorry. They sort of emulate equities or something like that. So okay. FTT was the FTX token, and the role of FTT was not only to add to firm. It wasn't intended to add to firm capital, but the original idea was that customers who bought FTT were kind of showing they had a vested interest in the exchange, and in so doing, they could lower their transaction costs. So if you were a large holder, or at least a substantial holder of FTT tokens, you would trade for a lower level, and sort of that's also a way of sort of adding capital to the firm and making yourself a more important, say, user of the service. So that was the initial idea, but it wound up taking sort of a negative turn as the amount of FTT tokens began to become a substantial portion of the firm's overall capital.
And FTT was that token that you said that FTX themselves put out, and right. that was a part of this whole. Situation or scheme, or depending on how you want to put it. I mean, I guess when FTX went into bankruptcy, they appointed a gentleman named John Ray to oversee it. And in his earlier career, I know he supervised the bankruptcy of Enron. And Mr. Ray made a statement to the effect that never in his career he had ever seen such a failure of corporate controls, or like a complete and total lack of trustworthy information. So although initially I think Mr. Sam there was trying to spin this as they simply got caught in some fluctuating cryptocurrency markets. These have been very volatile. It seems like there was some just old-fashioned fraud involved here.
Yeah, so all throughout 2022, as inflation began, inflation really started in early 2021, but in early 2022, you had inflation start to become a lot more evident to consumers. We had the Russian invasion of Ukraine, we had high gas prices. And so what began happening is all of that, on top of the fact that we had 3 years of expansionary policies on the part of the Fed lifting up asset prices, we had this huge liquidation. And so while there's been a hope for a long time that cryptos would be sort of inflation hedges, because a lot of them are their supply is algorithmically limited. Right. So like gold, whose virtue is that you can only pull so much out of the ground, it was thought that cryptocurrencies would be an inflation hedge. Not at all the case. What we found is in a general liquidation of assets, crypto gets thrown out as quickly as everything else. And so throughout 2022, you had all these cryptos getting liquidated alongside equities, fixed income, or other instruments. And the FTT token was part of that.
No, if we can just expand on this a little bit, because I think that's a fairly important point. And like with Bitcoin and other cryptocurrencies, there's a computer program that really does limit the number of Bitcoins that there'll ever be according to this program. And like you said, it's stored on all these different computers, so it's very hard. Some people claim it's unhackable, but you have this very strict limit on the number of Bitcoins that there's going to be. And yet you also said they sort of got caught up in this inflationary cycle, not because there was any inflation in Bitcoin, but simply because it was one of the many, investments that people were putting their money into as the Federal Reserve was expanding the money supply. Is that what was happening?
Yeah, by the end of 2020, Bitcoin was absolutely running. And a lot of new money was created. We're talking about Cantillon effects here, a lot of new money going into various financial markets. And Bitcoin was one of the main beneficiaries of that. But that spread soon to many, many other tokens, many other cryptocurrencies. The whole ecology, the whole set of tokens were running up in price. And come early 2022, there was a rush to the exits. And everything got thrown overboard pretty much at the same time.
And so then, I guess if people are trying to liquidate some of their positions in these, then that's going to drive down. Anytime you have a bunch of people trying to sell an asset, that's, I guess, simple supply and demand. A lot of people trying to sell, it's going to drive down the value of the assets. Yeah,
a lot of these markets don't have dealers. So basically, the only selling you can do is to people who are bidding. And what happens when you have this precipitous fall in assets? Nobody's bidding. Right. Nobody's out there catching a falling knife. So what happens is these things fall until there are buyers, and many times that takes a while. In the case of FTX tokens, they fell well over 80% in a short amount of time, and that was a big part of the beginning. That was the beginning of the end, really, for FTX.
And there's been some reports, and obviously we're at a point now where I think we still don't absolutely know what happened. So we have to go a lot on what we see reporting, and maybe 2 years from now or 5 years from now there might be a different story on this. We might know some more facts that we don't currently have now. But it certainly seemed like FTX was manipulating the value of their FTT token, and then if I understand properly, but after selling banks and other lenders on the value of this FTT token, borrowing against it, which allowed them to sort of access that money, and then that's part of the money that has disappeared here.
Yeah, if I were to use an example, it would be like finding out what manufacturer makes a particular casino's chips, and then making them and bring them to the window in exchange for cash. FTX really did two things. They created a lot more tokens, which is very similar to fiat currency, central banking, and they also borrowed against them. Yeah. And two things happened. First of all, those FTT tokens fell precipitously in value, but also when the leadership of Binance, so just a quick, I need to back up for 1 second. There's really two models of cryptocurrency exchanges that were sort of vying for supremacy in terms of regulation. There's the exchange model, of which FTX was sort of the primary one. And then there's the Binance model, which is another firm that was sort of like a web-based one. And actually FTX and Binance, as sort of the duopoly, the two major firms, that was sort of a friendly relationship. But what happened was Binance owned a lot of FTT tokens. And when the Binance CEO, whose name escapes me at the moment, I'll remember it, when he found out that SBF and the leadership of FTX were in Washington, sort of advocating for themselves to be the regulatory model and for themselves essentially to be the self-regulatory head, they dumped all of their FTX tokens, all of their FTT, and that really pushed the value down even more. And that's when things reached the beginnings of a liquidity crisis within Alameda and within FTX.
And there were also allegations that Sam Bankman-Fried, I think we would call him SBF because that's what he's been referred to many times in the media, that SBF had, I guess, borrowed or moved some investors' account money from the exchange into his Alameda Research hedge fund. And I mean, that would be, that's just not acceptable, right? I mean, that's just a complete and total violation of the rules, right?
Yeah, I mean, that's as bad as it gets. So it was the fall in the FTT tokens and the liquidity crisis that led to the discovery that most of the customer funds were either absconded or missing. And so a lot of people have said that the FTX collapse is similar to Enron. I think it's correct on on maybe a psychological or media level, but a huge attention-grabbing event. But I think it's more akin to a more obscure crisis that occurred in maybe 2013. That's the 2011 to 2013. That's the MF Global debacle. Because in the MF Global debacle, it turned out that a very large very large Wall Street firm was using customer funds to meet their corporate obligations. And there's a huge, and I mean a huge prohibition in financial markets on commingling customer and firm funds. Two basic things. Every customer's account, whether it's securities or cash, has to be kept separate. You can't have all customer accounts in a giant electronic pile, essentially. And the second thing is that you can never, ever, as a brokerage firm, use customer funds for any other purpose other than, if they want to wire, if they want to buy something. You can't use it to meet your bills. You can't use it to satisfy other obligations. And so, the poor control is definitely part of it, but I think the senior people absolutely knew what was happening. And what I don't think they knew is, I don't think they knew they were dead in the water. By the time the FTX tokens were falling, there was no future for FTX.
And so now SBF has now been arrested, and there's charges against him, and certainly it seems like from what's been reported, this like commingling or absconding of customer funds would clearly be illegal and something that they're about being in a lot of legal trouble for. Now,
yeah, absolutely.
There's some more to the story that we haven't gotten into yet, and that is especially in the 2022 election cycle, SBF was a major political donor. He gave millions and millions of dollars to a lot of political candidates. I think over $5 million to President Biden. I guess that would have been back in 2020, but he's been giving millions and millions of dollars to politicians, mostly Democrats, although a few Republicans have gotten some money. And then it's on the order of tens of millions of dollars of donations to nonprofits, again, mostly for progressive causes. So that's another, because this gets into this part that that SBF was talking about, effective altruism. So what's your take on this this other part of it? He's giving out all this money to politicians and then to nonprofits.
So effective altruism is basically a rebranding of basic philanthropy. It suggests, but specifically in the case of effective altruism, there's a suggestion that there's this evidence-based process that involves calculating where your money will do the best and then giving it away so it makes the biggest impact. And of course, you mentioned the nonprofits. Sam Bankman-Fried had given a lot of money to climate change causes, things like that. But a lot of money was given, as you said, to political campaigns. It's very difficult for me to see that as a manifestation of effective altruism. Mm-hmm. Those donations that he made were had far more to do with pending crypto legislation. Right. As I mentioned, there's really two major models for cryptocurrency that were being proposed in Washington. His idea and his firm, FTX, sort of was the model of one of them. So that was the basis for spending heavily on those individuals in Congress and regulators. And to the extent that there are people out there who lost money in FTX who now know that their money was not only used in corporate purposes, but might have been used for political donations or for philanthropic giving that's sort of averse to their personal beliefs. It's one thing if Sam Bankman-Fried made millions of dollars off of his firm and then did that, but there's a good chance, in fact, I think it's probably beyond the shadow of a doubt now, that he was using actual customer funds to promote those causes.
Yeah, because I know that Mr. Ray is trying to go after the politicians who received some of this money, presumably because he has some evidence that money actually belonged to the customers, and that's why he's trying to get that money back in the bankruptcy process here. Before we go on to regulation and lessons for regulation about this, let's mention a little bit about bankruptcy, the bankruptcy process here, because FTX did go bankrupt, but if you don't follow bankruptcy, if you don't know what's involved legally and financially with bankruptcy, you might figure, well, once a firm declares bankruptcy, that must mean there's no money left at all. But it's actually a legal process to try to protect all of the creditors of a company where it looks like, they are not going to have enough money, but it doesn't mean that they don't have any money. They simply don't have enough money to pay all of their creditors, right?
Yeah, so colloquially, we use the term bankruptcy synonymous with, insolvent or out of business, but that's not the case at all. Bankruptcy is essentially a legal status that a firm applies for and can be given in court, and that gives it protection to the claims of its creditors, and while it reorganizes its debts. And, without bankruptcy, what you would have is firms would, conceivably pick and choose the obligations they satisfy, those they don't, not pay at all, that sort of thing. And there's also a concern about the pecking order of creditors, right? So secured creditors, which hold collateral, are supposed to be paid first, then general creditors, then the unsecured creditors, and then finally equity shareholders. And in my experience, which is between 20 and 30 years of actually being a trader or watching what was going on Wall Street, there's usually nothing left for shareholders when that happens. But bankruptcy is a very important part of the rationalization of commercial processes. It's very important. And so FTX is currently, it's in bankruptcy reorganization. What will emerge, we don't know. But at the very least, we're now getting a clawback of funds, and those firms and others who are creditors are getting at least some of what they are owed back.
Yeah, and hopefully, as this process goes on, and it's quite possible Mr. Ray's going to find some of this money. I suspect that SBF had some of it hidden in different places. It might be kind of hard to find, but if he can uncover any of it, figure out where any of it is, I guess that money could eventually go back to some of the people who lost their money here.
Yep. Yeah, that's the idea. We do know that SBF bought houses and cars for people, which is really unseemly. So some of that will be clawed back in the process of bankruptcy.
Now, I want to turn now to some of the lessons for regulation about this. And one of the things that happened almost immediately after the scandal started breaking was the Securities and Exchange Commission and the Commodities Futures Trading Commission announced that they were going to investigate FTX. And one question would have been, well, perhaps they should have, where were they for the last several years before this, when they might have raised some red flags and maybe saved some of the people who had their money invested in FTX, maybe could have saved them their money before it got absconded with. So, what do you think about, should the SEC and others have acted earlier, and why weren't they?
So we do know now, it came out after the FTX bankruptcy, that that there was an investigation at one point in the spring. Now, those investigations usually progress very slowly. We don't know exactly what they were investigating, but I think the bigger answer is that the actual headquarters, the holding company of FTX, was a Bahama-based, was incorporated in Antigua and based in the Bahamas, and that's essentially outside the jurisdiction of U.S. regulators. So the U.S. subsidiary wasn't being investigated. Again, I don't know how much we know about that, but there's also the factor that the firm was super high profile in Washington. You know, when you have a firm that's doing Super Bowl ads and they put their names on an NBA arena and they have a $30 billion valuation, they're having cocktail meet and greets in the U.S. Capitol. The fact is that they are really not setting off many alarm bells. There's this idea that they couldn't possibly be either stealing money or doing something, that's below board while being that high profile. But and the political donations don't hurt. But that was the case. I think they were hiding in plain sight, as it were.
Yeah, because certainly, I know SBF was appearing on these very high profile panels, like with Bill Clinton and some of the most distinguished. Right. People across the country, across the world, really, yep. and was even appearing at some events after the bankruptcy, but before he was arrested, which I think he was arrested about a month or so after the implosion there.
Yeah, it was astounding. I mean, he was on some New York Times panel, weeks afterwards, and there were people saying this guy. There were many people who were common people who had made a lot of money in crypto, and now they're, from rags to riches to rags in 5 years. Mm-hmm. They've lost everything. So seeing him seemingly escape the law, escape repercussions for some number of weeks afterwards really left a bad taste in many people's mouths.
But I mean, there's also the side of it that there is a legal process, and we are pursuing indictments or whatever. You do have to jump through some legal process there, and I think right. There were some parallels, or some people were talking about the case of Bernie Madoff, who had run a fraudulent hedge fund that blew up, but. I believe in his case, when he was questioned about it, he actually admitted, that this was a fraud. And of course, that makes it very easy to then go ahead and arrest him because he just sort of admitted, what he was doing.
There's some parallels between Madoff and SBF and FTX. I mean, so SBF and the FTX situation was not, as I understand it, at the point where it collapsed, a Ponzi scheme. They hadn't yet gotten to the point where they were soliciting donations and paying out, depositors or people requesting their money. But there was very much a clawback situation in the Madoff situation, in the Madoff case, because just before the $50 billion Madoff scam was discovered, he had paid out large bonuses to people. A number of people had been very fortunate to ask for their money back and got it. And the bankruptcy trustee said, we cannot allow that. We're going to take that money back. We're going to claw it back. And we're going to apportion it, more equally among claimants. So that was, in that way, although the name was used a lot, in that way, the FTX and the Madoff scandals are similar.
No, we've already mentioned that you mentioned how FTX, is a year or so, long before the blow-up happened, was trying to pursue favorable regulation for its model of a cryptocurrency exchange. And is that sort of like a bigger lesson here for regulation going forward? That many times, we think you're going to have regulation that's going to benefit consumers, but the people who write the regulations are really sort of the insiders, and it's in some sense always going to be an insider game.
Yeah, I think anybody who thought, so there's a very strong strain within cryptocurrency fandom or cryptocurrency proponency of almost utopianism. Mm-hmm. And what we saw here is that at some level, whatever cryptocurrencies represent, stateless money, whatever, as long as there are these businesses like these large exchanges and all that sort of thing, you're still going to have cronyism, you're going to have rent seeking and everything that we know from the more familiar businesses going back to railroads and before that.
Yeah, well, it's in some ways, cryptocurrency is completely brand new, but then there's also some timeless lessons in finance. And I guess one of the timeless lessons in finance is people are always trying to get their hands on other people's money.
People are people, that's right.
Well, thanks very much for coming on and joining us. And join us again next time for another EconVersations.
This has been EconVersations, a joint production of Troy Trojan Vision and the Manuel H. Johnson Center for Political Economy at Troy University.